from DSD Business Systems. I want to thank you all for joining us for today's webinar, ACA Reporting and Tracking, Are You Ready? Before we get started, I want to tell you a little bit about DSD Business Systems. Today's webinar is brought to you by DSD Business Systems, and we provide accounting, ERP, and business management solutions for your business. Founded in 1984, DSD serves customers across the globe in the U.S., Canada, Mexico, and Europe. We have over 30 offices nationwide ready and willing to help serve your business. Please feel free to contact us if you have any questions about today's webinar or you'd like to discuss a free business consultation. And we'll have room for Q&A at the end. Our speaker today is Neil J. Staley, Executive VP of Benefits Division at Mars Maddox, Hub International Insurance Services. Neil has been a driving force in the employee benefits field for over 25 years. Neil holds the PPACA Healthcare Reform Specialist designation from the National Association of Health Underwriters. He has completed extensive employee benefits training, including all lines of insurance coverage and COBRA, HIPAA, and Section 125 administration. Neil has a broad experience in the evaluation and implementation of all types of employee benefits plans, including multi-state risk, partial self-funded plans, and cafeteria plans. Throughout the presentation, again, please type in any questions you may have, and we'll have a brief Q&A following the presentation. I would like to pass the presentation over to Neil now to begin.
Thank you, Leah, and thank you for having me today, and look forward to speaking to you folks about the Affordable Care Act and how it relates to employee tracking as well as IRS reporting. So the four items that we're going to concentrate on are the applicable large employer and what that is, tracking your part-time employees that may or may not become eligible for benefits under ACA, Section 6055 and 6056, which are the new sections that are relative to IRS reporting for healthcare, and then also looking at the new age rating that companies from 50 to 99 employees are looking at in 2016. So what is an applicable large employer? And I assume that this is a review for many of you. The applicable large employer determination is done based on full-time equivalents, not full-time employees. Some people make the mistake of just looking at their full-time employees, but it's actually FTEs, which the best way to do this is to take two buckets of your employees. Take your full-time employees that work 30 hours per week or 130 hours per month, put them in one box. And then take all the remaining part-time employees that work less than that, add up all their hours for a month, so all of those part-time employees, and then divide by 120 hours, and that's going to give you the number of part-time employees that equal full-time equivalents. Add those two buckets together, and that's going to tell you whether you are a full-time, applicable large employer or an ALE. There we go. Effective on January 1st of 15, or the plan renewal in 2015, the applicable large employer for most employers is going to be one that has 100 or more full-time equivalents based on that calculation that I just described. Effective January 1 in 2016, or plan renewal in 2016, so when I say plan renewal, your medical plan year, it will be 50 or more full-time equivalents. So let's review the employer mandate. Again, I just want to review all these things so everybody's aware of what we're talking about when it comes to who needs to do what when it comes to the Affordable Care Act right now. So in 2015, employers with 100+ full-time equivalents, their potential penalty if they were not going to be offering health coverage or considering dropping their health coverage, their penalty would be $2,000 for each full-time employee that is, that works 30 hours per week after the first 80 employees. So in the first year, they're giving you a break of 80 employees that you would not pay a penalty for, and any employee after that, you would pay a $2,000 penalty. So if we take an employer that has 100 full-time employees, your cost would be roughly $40,000 in this first year, 2015. And that is a non-tax deductible expense, whereas medical premiums, as you know, are tax deductible. 2016, employers with 50-plus full-time employees, full-time equivalents, will have a potential penalty again at $2,000. However, it will just be the first 30 that you're exempt from, and any amount after that would be subject to the penalty. So if you take 100 employees, you're going to be looking at $140,000 of penalty, non-tax deductible. So let's take a look at that employer that does offer health coverage and whether there's any potential for having penalties for that type of employer. The questions you need to ask is, what is the employee's portion of the premium? So we're not talking about dependent premium, we're talking about employee portion. Does the employee's portion exceed 9.5% of their income? Is the employer providing affordable coverage? It's answered by those first two questions, because if they are paying more than 9.5% of their pay for employee-only coverage, then that's considered unaffordable coverage by the guidelines of ACA. So in 2015 or 16, then when you become an applicable large employer based on our previous slides, there's a potential of a $3,000 penalty for each employee that qualifies for a subsidy through the exchange. So it's important that the potential part, because in order to get that penalty, an employee needs to go to the exchange, qualify for a subsidy, then the government will come back to the employer for that $3,000 penalty, but only for that employee. They will not go and audit your entire company and then charge you $3,000 for each employee that has unaffordable coverage. The trigger has to be that they go to the exchange and obtain a subsidy. If you don't have anybody paying over 9.5% of their income, there's likely not going to be any penalty for you as an employer. And again, that penalty is a non-tax deductible. Tracking part-time employees, this is important as an applicable large employer. When do I start tracking? It's going to depend on whether you are over 100 full-time employees in 2014. 100 or more full-time equivalents are going to be tracking, should begin in 2014 for 2015. Between 50 and 99 FTEs, tracking should be again in 2015 for 2016. The options for tracking, there's two ways the government allows you to go. You can go what most employers would say is not a practical way, which is that every single month you would measure to see whether any of your part-time employees became a full-time employee based on the 30-hour-a-week rule, put them on coverage or take them off coverage as every single month. That can become an administrative nightmare, especially if you have a lot of employees that are in the part-time category. So what the government allows you to do is to establish a measurement period, which constitutes basically 4 periods. There's an initial measurement period. That's the period at which, when the employee is first hired, you track their hours for the entire measurement period, and that can be anywhere from 3 months to a year, depending on what you choose. And if that employee exceeds an average of 130 hours a month, then they would have to be put on benefits for the stability period, which would be equal to the measurement period. The standard measurement period is going to be your ongoing measurement period for those employees that have been with you for some time. So they have an initial measurement period when they're first hired. The standard measurement period is going to be very similar, except that it's going to be a set time that is basically right before your renewal date of your benefits. The administrative period is a period at which you have, after either of those two measurement periods, and it's usually 1 or 2 months, that's going to allow you to put the person on benefits or basically analyze whether they need to be on benefits. So now we're going to talk about Section 6055 and 6056 IRS reporting. The background. Let's just why does the IRS need this reporting? The employer and the insurer reporting of this plan and coverage information is to assist the IRS to administrate basically the Affordable Care Act, especially as it relates to the employer mandate. So we have the individual compliance side of the employer of the ACA, which is the individual mandate, making sure that any person, not an employee, but any person has a minimum essential coverage to avoid the penalty associated with the individual mandate. So under individual eligibility, you have the premium tax credit subsidy issue. Do they qualify for a premium tax credit subsidy? Do they have affordable coverage at work? If they do, they don't qualify. So all of that comes into play with the IRS and the reporting that's necessary to administrate those rules. Employer compliance is again with the employer shared responsibility or employer mandate that we've been talking about. They need to determine with this reporting whether you're offering coverage to full-time employees and dependent children under that provision of the law. Section 6055 is going to be reporting on those covered under the minimum essential coverage, which is what MEC is. And it's used for enforcing the individual mandate. Insurers are going to report for fully insured plans. So the insurer are going to report the documents that I'll talk about in a minute for the fully insured plans. Employers report for self-insured plans regardless of size. And for 6056, the applicable large employer that we talked about earlier will report on coverage offers. And it's used for enforcing, again, the employer shared responsibility rules or employer mandate. And it's used for determining subsidy eligibility through the marketplace or the exchange. So only a small employer, less than 50 full-time employees or full-time equivalent employees offering no coverage or only fully insured coverage are exempt from reporting. So if you're a self-funded employer less than 50, you're going to be reporting. If you're a fully insured employer under 50, you are exempt from reporting. Or if you don't offer any coverage at all and you're under the 50 full-time equivalents. So let's talk about the forms that are going to be spit out going forward. It's interesting because a lot of CPAs and their documents for setting up, doing your taxes. I even received a document from my CPA saying that they needed the 1095-C form, and that's not something that's been even mandated to produce yet. That's going to come out here in 2016. So the Form 1095-B and C, and that just has to do with whether it's self-funded or fully insured. The individual return or employee statement is due to the employee by January 31st, 2016 and subsequent years. So you as an employer, as an applicable large employer, are going to be responsible for producing this form, just like you produce the W-2 for your employees. The 1094-B and C form is going to be basically a single transmittal of employer data to the IRS. So it's going to be due January 28th of 16 and subsequent years of filing paper, or March 31st if you're electronic filing. So that's a single transmittal. The 1094 is a single transmittal from the employer. The 1095 is the individual document that goes to each and every employee. And I just want to point out that this is all based on calendar year, even if you are a non-calendar year plan. So these documents are required based on a calendar year. So what has to be on this 1095-C? So you have to be able to produce the name of the employee, the Social Security number or date of birth if you made the required 3 efforts are made to obtain the Social Security number and you didn't receive, complete mailing address, name of the employer and the federal ID number, applicable large employer mailing address, phone number of person to contact for questions, and then coverage for each calendar month, yes or no, only need coverage for any one day during that year in order to have to report that. Again, small employers with self-funded coverage reports the same information on Form 1095B. So even a small employer that's self-funded would have to report this. Let's talk about something that's not as much related to reporting, however it is, because eventually you are going to have to report this information. But what's going to happen here very soon in 2016 is that groups that are right now composite rated for their medical insurance, in other words, you have an employee-only rate, you have an employee-spouse rate, you have a family rate, but it's all the same no matter what the age is actually going to be changing unless they delay this or they strike this from the law. 2016, groups from 50 to 99 employees will become small groups in terms of medical insurance. Don't get that confused with the applicable large employer. It's just for medical insurance. Those employer groups will then become age-rated just like the small employers are right now that are below 50. And this is going to be really disruptive because now each employee would have their own age rate each year. Every spouse would have their own age rate. Every child that's over the age of 18 would have their own rate based on their age, based on their rate they would be if they were an employee. All the children would each have a rate up to a maximum of 3. After 3, there's no charge, and we like to say that the dog's still not eligible, but that may be coming, who knows. This is going to be real disruptive because you're used to just having one rate if it was an employee, one rate is employee spouse. Now you're going to have some technology behind you, in my opinion, and this is what we've been working with our clients quite a bit on, to help them manage this types of rate structure and get through this process where you're going to become a whole different rated group going forward at your renewal in 2016. So if you renew in May of 2016, this is when you're looking at this. So it's really important to keep an eye on this. Many of the carriers, I will give you a hint, many of the carriers right now are giving the opportunity to renew early. So for example, there's carriers out there that will say, for this rate increase, let's say you're a May 1, for this rate increase, we'll renew you early in December so that it will extend you all the way till the following December without this new age banding. So in other words, delay the inevitable. But it does, but a lot of employers are taking advantage of that. We have a lot of employers that are, but that's something you definitely want to look into if you're in this category of 50 to 99 eligible employees. So how can you manage these new requirements? A lot of our clients have benefits administration systems, and of course they have a payroll system. Many of those can help. There's prices all over the board to do these types of things, but it's really important to talk to them now and see what are the capabilities, and then potentially look into it. And the folks here at DSD could help you navigate this, because I know that the systems they represent can take care of a lot of these issues that I've talked about and put you at ease for come January, when all of this is going to be crunch time to get this reporting out. I'm going to turn it over to Nick here, who's going to talk a little bit more about how the SAGE systems can help you with this.
All right, thank you so much. Hi, everyone. My name is Nick Markham, a SAGE HRMS consultant here at DSD. Extremely interesting, but if you're scared out there, don't worry. There's a lot of help at DSD. So if you have a SAGE HRMS system, there's a simple add-on solution called My Workforce Analyzer, SAGE My Workforce Analyzer. So when using SAGE My Workforce Analyzer, you will be able to track and analyze the real-time data from your SAGE HRMS, determine if you qualify as a large employer, if you should offer coverage or take a penalty, part-time and full-time eligibility, and coverage affordability. It's very simple. There's also an easy-to-read dashboard that allows you to monitor the hours worked by your part-time workforce and stay ahead of when you need to offer employees benefits. Most importantly, the most important part is you're able to print, edit, print, and mail, if you prefer mail, or of course e-file the 1094-C and 1095-C forms to the IRS. Also, there is, if you prefer SaaS, software as a service, or ACA, of course, also known as cloud-based or web-based HR solution, if you prefer this method of deployment, besides tracking and analyzing your data for the Affordable Care Act requirements and providing the required 1094-C and 1095-C forms, you will be able to manage all of your HR information from hire to termination. So we can help you out with that if you prefer this method of deployment. Also, if you have an outsourced payroll service, some providers offer ACA tracking as an extra cost. Neil said, please check with them, see what their offer is. So we've heard, for example, that ADP offers ACA tracking for an additional $3 per employee per month cost. So with Sage My Workforce Analyzer, you actually have the ability to import your payroll information and dependent information as well. Now I'm going to turn it back over to Leah to close out with questions and answers.
Thank you, Nick. That was great. So if there's any further questions today, we're going to open it up to questions. And we have both Neil and Nick here ready to answer any questions you might have. So please type in your questions and we'll be sure to get them answered. So don't be shy. If there's any questions at all, please type them in. So the first question today we have, is the pay calculation based on gross or net?
Yeah, so it is based on gross. However, there's a couple different ways that the employer can choose to have the safe harbor to avoid that 9.5% rule, and it depends on how you pay your employees. So some employers will choose hourly basis where everybody would be based on 30 hours regardless of how many hours they work, and then there's and as long as when you base it on the 30 hours a week, that they are not going to exceed that 9.5% when you compare it to what the cost would be. You can do it with that safe harbor, or you can do it with the box one earnings on the gross pay on the W-2. So you can choose which to use on that.
Great, thank you. So the next question we have today, I'll direct this one to Nick. The question is, how does the HRMS link to time and attendance work?
Yeah, so how that works is you kick it out in a CSV. You export out the CSV file, and the Sage My Workforce Analyzer imports in. Very simple export-import capability.
Great, thank you. And another question, these slides will be available for download. So we'll be sure to send you a link to the slides and to the recording after today's webinar. Another question for today, what if the employer offers affordable benefits and meets all the criteria and the employee waives the coverage?
That's a good question. The key is that you offer affordable coverage. You can have virtually nobody take the coverage as long as you offer affordable coverage and you meet all the guidelines, the 9.5% rule, and you're offering an affordable plan. You've met the safe harbor. And just because somebody waives coverage, you will not be subject to a potential penalty.
Another question today, what is the insurance company filing for us?
The insurance company is going to be filing if you're a fully insured plan, but that doesn't. But they will not. That will not exclude you from having to file as well. So they file under the same report, the IRS reporting requirements. But if you to meet the criteria of an applicable large employer, like we talked about before, you will still need to do the filing, the individual transmittal, as well as the 1095-C as a fully insured plan. It's basically going to be a double reporting, in essence, in a lot of cases, if it's not self-funded. So yes, they will report, but you have to do it as well.
Thank you, Neil. Our next question we have is, we have Sage 100 ERP. Does this have the same capabilities that Sage HRMS has? And is there an add-on available?
It's a great question, and actually you need the Sage HRMS to bring in Sage My Workforce Analyzer for the Affordable Care Act reporting. So we can talk further about that. Just please contact DSD. And the next question I can actually answer, does My Workforce Analyzer, is that compatible with the Sage Average Suite version 9.2? The answer to that is yes. It is compatible with Sage HRMS 2015 and Sage Average Suite 9.2.
Nick, do you want to take the next one as well?
What tools if you have Sage 100 payroll? Yeah, so you need Sage HRMS, the HR, to do the Sage My Workforce Analyzer. And what we do with the Sage 100 payroll is, again, export out the CSV file, then import into My Workforce Analyzer in a CSV file. If you have Sage, if I have Sage HRMS, the Workforce Analyzer add-on can handle all the reporting requirements. That's correct. It handles the 1094-C, 1095-C. Of course, you're able to track, measure, monitor all your part-time workforce. But the most important part, of course, is the filing of the forms. So that you are able to produce, edit, print, and as I said, you can file, paper, mail, but most efficient way is you can e-file these to the IRS. Another question I see here, if I use Sage HRMS for benefits only and have an outside payroll company, will Workforce Analyzer work between both these to get my reporting done? This is correct. Yes, you just import your hours into the Sage My Workforce Analyzer reporting tool, and it works right there for you, and you're able to, again, edit, print, and e-file those forms to the IRS.
Okay. Another question we have, I believe this one will be directed at Neil. Does the 9.5% apply for what we charge for dependent coverage?
No, it's based on employee-only coverage. So the dependent coverage, you can charge 100% of the dependent coverage, and that doesn't count against it. So the calculation you want is based on employee-only, what you charge to cover your employee-only.
Okay. Will we need to report employees that waived coverage?
Yes, you will need to report for them. However, their 1095-C will report that they do not have coverage. So you will be reporting for all your full-time employees.
Okay. And do sole proprietors have to report anything?
Only if you're over, if you're a sole proprietor and you have over 50 employees, 50 full-time equivalents, then yes, but it has nothing to do with the type of entity you are. It has to do with how many employees you have.
Great. So I think we've answered the questions so far that have come in. Feel free to type in any further questions you have, and we'll stay on the line to answer any additional questions you have. Actually, while we're waiting for those questions, I'm going to put up Neil's contact information. So here's DSD Business Systems contact information. If you have any other questions from today's webinar that you would like answered, feel free to reach out to us at info@dsdinc.com. And you can also reach us at 800-627-9032. And then in regards to Neil, here's Neil's information as well. It's neil.staley@Hub International. So another question we have that's come in, if we add Workforce Analyzer now, is it possible to catch up for the months that have passed? And I'm going to pass that one over to Nick.
Great question. What we do is set up your measurement period, look back period, and then from there it goes ahead and tracks and determines and monitors your hours worked from that period. So all you do is you set up your parameters. It's very simple to do. So contact us and we'll help you out with that.
When is the latest I can report for 2015? And how long would it take to get Sage HRMS set up to help?
I'll answer the first part. The first part is that you have to report in January. You're going to be basically doing it in January of 2016. And that's for getting the 1095 forms out, and then the 1094 form transmittal is due at the end of February or March, depending on if you do it electronically. And then I'll let you take the.
Yeah. And how long will it take to get Sage HRMS set up to help? Actually, that's a great question, because it always depends on the size of your organization. But usually we do anticipate around 60 days to 3 months. Of course, it always depends on when we have that conversation. We start diving in, discovering wonderful tools that we can use in Sage HR, and then we start getting into the Affordable Care Act Sage My Workforce Analyzer. So please, again, contact your DSD here, and we'll go ahead and help you out with that.
And actually, Nick, while we have you here, could you also expand on what Sage RMS add-on is?
Yeah, so Sage HRMS add-on is called Sage My Workforce Analyzer. So again, it's a reporting tracking tool to determine if you qualify as a large employer. So inside this tool, you're able to determine if you qualify as a large employer, if you should offer coverage or take a penalty, able to actually monitor part-time and full-time eligibility and coverage affordability. So inside the actual Sage My Workforce Analyzer, it's a very simple, easy-to-read dashboard that allows you to monitor those hours worked by your part-time workforce. And again, it allows you to determine if you need to offer benefits to your employees. The most important part about that, and I'll stress this too, is everyone asks me is like, okay, well that's great, but are the forms there? I need to send to the IRS. Well, yes, you're able to edit, print, and e-file those forms. But again, if you prefer the mail file, the paper snail mail method, you're able to do that as well.
Thank you. We have another question for Neil. Could you give a summary of the 1095 A, B, and C?
I'm not sure if you're looking for a summary, like a document summary, but we do have some documents on that. You can email me for that, Steve. But the 1095 A, B, and C, the differences, so those are the documents, and we have those sample documents and everything that I can show you. They're actually on the IRS website as well. The difference between the A, B, and C is whether it's fully insured, self-funded, or coming from the exchange. So the 1095C is the document for those that are already enrolled in exchange, the government program, and they would have received those 1095C, I believe, this year, even though on the employer side they're not required till next year.
Okay. Feel free to type in any further questions you have.
While everyone's typing in questions, I'd like to add something as well. Now, if you currently have Sage My Workforce Analyzer, there is an update coming here in a few weeks that will provide you with the ability to edit and e-file those important forms. So currently right now you don't have the old version. The current version does not have that ability, but the version coming out here in a couple weeks does have that ability to edit and e-file those forms. So you're probably wondering if I don't have that ability. It's coming out with a new update here real soon, okay?
So we have one other question. The question for today is, who assesses and collects penalties and by what method? Do they root you out?
So that's a good question. So the way that it triggers the event to get charged for the 2000 penalty, the penalty that if you don't offer health insurance whatsoever, that is going to be once you have one employee go to the exchange, get a subsidy, then that triggers that event. And then you'll be charged for all of those employees, and they will do that at the end of the plan year. So at the end of the calendar year, they'll charge. It was going to be on a monthly basis, but my understanding is now that they will basically do an analysis at the end of after the end of the calendar year. So question, do they root you out? Yes, they'll find you for those dollars on the $2,000 penalty. The $3,000 penalty, which is the one where if you are not offering affordable coverage, excuse me, that is going to be triggered by somebody that goes to the exchange. They determine you don't have affordable coverage. The government will come to you. My understanding that that will also be billed to the employer after the end of the plan year, after the end of the calendar year. That it will pay you the full expense there, penalty. And my understanding is that it will be prorated if you have, excuse me, an employee that is there for a partial year. So, but that's my understanding. Yeah, so if an employee, the next question was what happens to employees that don't go to the exchange, i.e. they fly under the radar also, their tax return, if they file one, triggers the investigation. Yeah, so as we move forward into filing taxes, there's going to be a box that they have to check off on whether they have health insurance. For this last year, for 2014, it basically was on the honor system. Next year, they're going to have that one way or another. The only way they're going to avoid the penalty is if they have the 1095 form. So if they don't have that form, they're going to be charged an individual penalty.
Okay. We'll wait a few more. Yeah. Other additional questions?
On a box question, he says, who assesses? It is the IRS that collects penalties. You got it, Bob.
Well, I want to once again thank you, Neil, so much, and also Nick Markham for their help today. This was a wonderful presentation. And then we'll hang around in addition for if you have any further questions. But if you come up with a question tomorrow, feel free to reach out to us and ask us, and we'll be happy to help you out. We want to thank you all for joining us today, and please enjoy the rest of your day. So this concludes today's webinar. Thank you again for joining us.